So unless you've been living under a rock recently, you've probably noticed that the economy seems to be slowing a bit and has been for the last couple of months. And a lot of you may be wondering what that means for mortgage interest rates. So ultimately, mortgage rates can react to a slowing economy in several different ways, and a lot of that depends upon why the economy is slowing. Today, we're going to talk more about our specific scenario right now in the current market and ultimately the reason for why the economy is slowing. You've heard me say in other videos, we've talked a lot about inflation. Mortgage rates hate inflation. The main reason the economy is slowing right now is ultimately because the Federal Reserve has increased Fed funds rates, which is basically the rate at which banks borrow money from each other. And as a result, when the banks borrow money at a higher rate of interest, they're going to pass along that cost to consumers as well, which is ultimately meant to slow the consumer's activity down. So basically the slowing of activity for the consumer will allow more time for basically the imbalance of supply and demand to catch up with one another. So the main reason why the economy is slowing right now is it's purposeful. It is a situation that was created by the Federal Reserve in an effort to basically fight inflation and bring inflation numbers down. So what that means for mortgage rates, as inflation numbers slow or basically come down because of the economy that's slowing, mortgage rates will ultimately end up coming down as well. Right now the fight that the Federal Reserve is having, or the challenge that they're having, is bringing inflation numbers down and slowing the economy without putting us into a recession. Now, some people will say we're already in a recession. There's definitely some technical indicators out there that would imply that we're in a recession. If we are, I feel like it's relatively mild at this point in time. Hopefully it stays that way. But the Federal Reserve is trying to slow the economy, bring inflation numbers down, and bring us into what they call a soft landing, where basically they're able to accomplish their goals without putting us into a recessionary period. So again, mortgage rates hate inflation. As the economy slows, typically inflation numbers will come back down. Mortgage rates will follow suit as well. We're anticipating that over the next several months, 8 to 12 months, maybe sooner, maybe longer, it's hard to say for sure because it ultimately depends upon the economy and the inflation figures and if the Federal Reserve actions have the desired impact. But we anticipate that mortgage rates will eventually come down as the inflation numbers come down as well, which could potentially provide a lot of people that purchased this year with the opportunity to refinance at rates that are lower than what they were able to achieve or obtain this year. So hopefully that helps to shed some light on what a slowing economy ultimately means for mortgage rates in our current situation. As always, we're here to answer questions. Feel free to reach out to us at any point in time. Have a great day.